Thank you very much for that very kind introduction. Thanks to Governor Kuroda for inviting me to deliver the Mayekawa lecture. And I'm greatly honored to be delivering a lecture in his name, again, given the confluence of both practice and research that he focused on. Let me talk about this area, which is bank regulation, but from the larger perspective of central banks and how this relates to some of the other activities that central banks do. How far have we come since the global financial crisis, and how much more do we need to do, not just in bank regulation, but financial regulation more generally? So given the limitations of time, I will go a little rapidly, but I do hope that we get a chance to ask questions at the end of this, and that will give you an opportunity to check on what I've said. Since the global financial crisis, I think one can argue that there have been a number of trends in regulation. The most obvious one is that we used to focus a lot on credit risk, on solvency, and after the financial crisis, we have started incorporating liquidity, both of financial institutions as well as the system, much more into our discussions. Not that we didn't think about it before, but it's become much more central because from illiquidity to insolvency, that route became much more pronounced during the global financial crisis. Related development, of course, is that we've gone from institutional regulation to also incorporate systemic regulation. One example is, if you remember early on in the global financial crisis, Ben Bernanke said the subprime mortgage issue is only about 100 billion in losses which have to be allocated. Well, it was a little bigger than that eventually, but it also, the problem was it was through the system. And because it was through the system, it infected the system and it created concerns in every part of it. So we've gone from focusing on institutional concerns to also more broadly including the system, and we understand the system can be polluted by specific institutions. Third, we've gone from microprudential to also thinking about the role of macroprudential regulation. How do we think about broad economy-wide or across institutions regulation, as well as increasingly what role monetary policy plays and whether monetary policy has any supportive role in helping financial regulation. And this is an area of a fair amount of debate and controversy, so I'll talk a little bit about this. And I think at the end of this, I'll try and summarize what we've done and what we need to do going forward. I think in some sense, our efforts have been very good on the banking side. We've made it much less possible for banks to be at the center of the next crisis. At the same time, if you regulate one side very well, the system is like a balloon. You press one side of the balloon, it bulges out on some other side. So where is it bulging out? I think Governor Kuroda mentioned, and I completely agree with the fact that it's possibly the shadow financial system where some of these risks have migrated. And we have to think about how we sort of apply more uniform pressure across the system, regulatory pressure across the system, so we don't have bulges in the balloon. And the second, I think, important place where we need to make more progress is understanding the links between monetary policy, capital flows, and financial fragility. I think this is something that Helen Ray will talk about a little more later on, but it is an issue we absolutely need to make more progress on, both domestically, the effects of monetary policy on rising financial fragility, but also internationally, the effects of sort of core country monetary policy on the rest of the system. And these are areas where we need more work. So in the spirit of the Mayekawa lecture, I will try and relate this to academic work that has been done and talk a little bit about the implications of academic work for the policy discussion. I want to focus on 6 topics. First is, why do we regulate banks? What's special about banks? It's an old question, and I'll try and come up with some of the sort of emerging answers. Second, what ways do we regulate them, and talk a little more about some of the things that have happened since the crisis. Third, talk a little bit about regulatory incentives. Of course, we have to pay attention to regulatory incentives and ask the question, who regulates the regulator in some sense? And then I want to talk about 3 special topics. One, should monetary policy be sensitive to financial stability issues? There are some people who bang on the table and say, no, 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 it can't possibly be sensitive. And there are others who say, if you don't, you keep having a recurrence of crises. And I'll talk a little bit about the arguments pro and con. Second, can macroprudential regulations solve some of the concerns associated with the monetary policy stance? Can we get separation again between regulation and monetary policy through macroprudential regulation? And final question, should we actually try and harmonize regulatory requirements at Basel as we try and do, or should we allow for each country to stand on its own bottom? So let me start first with why regulate banks. I'll go through it in a little bit of detail. The obvious reason is bank structure makes them fragile. And then the question is, why do banks have the structure they have? There are a number of answers that are coming up. Then a second question, a second reason to regulate banks is because they're so important. Because they're at the center of the payment system, there are a variety of reasons why we think there can be externalities if banks go down, and because they're at the center of providing liquidity also. So these are a second set of reasons to regulate. A third set of reasons is they're important, so that's the first 2 reasons, but also banks are especially prone to do things which normal commercial firms don't do. So there are aberrations in banks which also have to be guarded against. I'll talk about some of those aberrations and why we need to guard against them. The fourth reason is that the private sector can be allowed to function on its own, but the authorities sometimes have powers that the private sector doesn't have. And again, because of bank importance, the power of authorities to intervene can be very valuable in preserving the system. It's something that the private sector may not have. And there are some arguments like these that have been made in recent years. And the final argument for why regulate banks is because the authorities are going to intervene, the banks themselves have an incentive to undertake distortionary actions. And so, in a sense, the fact of intervention itself prompts regulation. You want to prevent the banks from taking advantage of betting that the authorities will intervene, and that's the 5th reason that this happens. Okay, so let me just walk through these 5 fairly quickly. The first reason to regulate banks is their structure makes them fragile. The canonical paper here is the Diamond-Dybvig paper, and those of you who know it, in a very straightforward sense, think of a economy where if you produce over the long term, you make high returns. If you're forced to cut short that production and produce over the short run, the returns are relatively low. Now, in that kind of economy, a bank can be a useful structure because it allows people to get some insurance against the fact that they may need to consume in the short run, and they're not saddled with the very low returns that occur if they need to consume in the short run. Essentially, the bank shares risks between individuals. It allows the people who come early to get a little more than the short-run production possibilities of the economy, in return for which they give up some of the long-run returns that they could get if they stayed patient and stayed over the long run. That sort of is the Diamond-Dybvig model. The beauty of that is, in a very simple model, it tells you why banks are fragile. Because if a small number of people come for their money early on, the long-term assets can be, a few of the long-term assets can be liquidated, and the long-run investors are also happy waiting because they get a higher return. But if too many people come early on, essentially you're giving too much to the short-run investors relative to the economy's production possibility, and as a result, the bank gets run, everybody runs for their money. That's sort of the idea behind Diamond-Dybvig, and it sort of captures this notion that banks are in fact fragile, but part of the fragility comes from the fact that they issue demand deposits. It's important for them to issue demand deposits in order for them to produce their basic function, which is this risk sharing. I'll move quickly to one other paper, which is this paper that Doug Diamond and I have written, which basically takes a somewhat related but little different view of demand deposits. And essentially it argues that even in a world where you don't have this risk sharing, part of the rationale for demand deposits is, in a sense, the fact that through issuing demand deposits, bankers can pay out much more of the value of the assets that they're financing. And essentially, through the demandable nature of the claim, that payment can be much higher. A third paper which has positive effects of debt issued by banks is the series of papers by Gorton and Pinaki and Dang, Gorton, and Holmstrom. Again, banks issue money-like liabilities. The virtue of demandable claims is they're very senior. There's not a lot of concern about what their true value will be because people are fairly certain about their true value so long as the bank is not anywhere near insolvency. And as a result, those are very liquid claims. People are willing to trade them, and the bank provides that liquid claim, and making it debt-like is very important for it to be very liquid. Now, why is all this important? It's important because it tells you that the bank structure is sort of not a bug. It's a feature of the system. It's something that is essential to what the bank does. Therefore, people who argue, and there are lots of people who do this after a crisis, let's replace the bank by an equity-financed institution without any demandable claims, are basically negating the very function of the bank itself. And you have to, therefore, balance the all-equity-financed institution against the loss of the fundamental activities of the bank. Let me, therefore, say the fragility that emerges from these demandable claims can emerge in at least three ways. One is you could have panics. And this was the historical view that people would see other people queuing up in front of the bank and they say, what's going on? I don't know. Let me join that queue. So It's a Wonderful Life is a classic example of this. And there they solved the problem by paying out everybody who came until people were satisfied and left their money in. Now, my view is these sunspots panics don't really happen that much. It's a nice theoretical view, but in general, what really happens in many banks is the runs start when the informed depositors, the big depositors, start running for their money. Typically, the hedge funds, the guys who have big transaction accounts, the interbank run, that's when it starts. And that's when banks come down in the modern world. It's not so much sunspot panics, but actual concerns about the bank solvency which precipitate these. Now, of course, the likelihood that these kinds of runs emerge much more likely when the bank is highly leveraged, because there's very little buffer for the bank to survive a shock before people start worrying about its solvency. As soon as they worry about solvency, they have an incentive to run and take their money out. And the third reason you could get a run is when there's an aggregate liquidity shortage, when there are fairly few buyers for the bank's assets, even though the fundamental value of the bank asset may be quite high in the long run, in the short run, when the bank dumps them, there are very few buyers. For example, in the financial crisis, we saw this with mortgage-backed securities, that during the depths of the crisis, there were very few people who understood the true value of the mortgage-backed security, who had the ability to go into the details of what backed it. BlackRock Maybe a couple of others, KKR, this, that, could do it, but not too many. And as a result, because there were very few buyers, relative to the mass of securities that had to be unloaded, they were trading at significant fire sale prices. That is what we call an aggregate liquidity shortage. The guys who can buy don't have the money to buy all that is being unloaded. The stuff that's unloaded trades at a huge discount. That creates enormous possibility of at least you're illiquid in the short run, which also means you're insolvent in the short run, even if you're solvent over the long run. Okay, a second rationale for banks is that there are externalities associated with this. The classic work here was the Friedman-Schwartz work, where they said that the Great Depression was caused by a collapse of banks and therefore a collapse of monetary aggregates. That there was a massive shrinkage in money supply, and as a result, activity collapsed. One could think at a very narrow level that a collapse of the payment system would lead to a collapse in activity. Ben Bernanke went further and said, no, it's not just the collapse of the payment system, but it's a collapse in the non-monetary functions. Banks make loans, and they make loans given their private information. There are these lending relationships. And what happens when the bank collapses is the lending relationships essentially evaporate. You can't resume them at short notice, so when the institution fails, there is nothing to take its place, and a lot of borrowers who used to get credit no longer get credit because the bank has collapsed. So he talked about credit being what collapsed, not just monetary aggregates. There's a whole bunch of work since then which has tried to establish that, in fact, there is a lot of this soft information between banks and their borrowers, which tends to evaporate when the institution fails. A third rationale has been these fire sales. And the idea is that in the fire sale, assets are sold for less than full value. But when an entity buys these assets, it doesn't fully internalize the consequence of creating these assets which might be sold in a fire sale, because people don't fully internalize the fact that they will be selling into that common pool of liquidity and essentially making use of that common pool. It's sort of making use of a public good. When you're making use of a public good, you don't internalize the fact that somebody has to produce that public good and you're relying on it. And so there is this charge on the common pool of liquidity when you sell some of these illiquid assets. And once you start selling these illiquid assets, you're dropping the price for those illiquid assets. That comes back to hit you through a potential fall in your solvency, eventually a run, and so on. There are a number of papers which talk about how you can get a systemic collapse because up front you don't internalize how much you're creating of these illiquid assets and relying on that common pool. And some of those papers are there. A third reason is that there are bank-specific problems, which over and above the fact banks are important, banks tend to behave in such a way as to exacerbate problems. So John Giannakopoulos has this view that the borrowers, in some sense, in an economy can be overly optimistic and can leverage up to a substantial extent. And when the over-optimism, when it turns out to be over-optimism, essentially that can create problems in the economy. Another sort of more bank-related idea is that banks have this ability to hide the true state of the world. They have the ability to evergreen. And so it is quite possible that banks, when they're competing with each other, can essentially lend to keep the loan going so that nobody really knows what the true state is. But when every bank knows every other bank is doing it, nobody wants to confess that it actually has a problem, that the loans are going bad. And as a result, you get over-lending over a period of time just to mask the previous over-lending. And eventually, when the regulator gets in and starts cleaning up, it turns out the true state is much worse than you thought it was, because there has been essential evergreening going on. I want to just show you the role of interbank competition from 2 slides in work that I've done recently. By the way, this is consistent with the most famous statement that was made during the crisis, which was Chuck Prince of Citicorp, when he was asked a few weeks before the crisis about whether lending was getting excessive. He said, you know, while the music's playing, we have to dance. The music's still playing. That's sort of the sense that interbank competition pushes you. Let me just show you a graph. One of the sort of areas that I've paid attention to in the past is the distance between borrower and lender. And typically over time, because of advances in technology, the distance between the borrower and the lender has been increasing. And that's what you see in this graph, that the distance has been increasing even in the last so many years. But what is interesting is during the run-up to the crisis, the distance expanded substantially. So in a sense, the banks were taking more risk than allowed by the steady expansion in distance. Now, if you're lending at a distance, you don't know as much about the borrower, right? And you may not have the technology to monitor them carefully, etc. Over time, the technologies are improving, but you can exceed the capacity of your technology. And what this says is just in the run-up to the financial crisis till 2008, the distance increased considerably, only to cut back substantially post-crisis. So that's one part. And I want to show you the second graph, which is even more interesting, which is showing that the green line is for branches which were in areas which were very concentrated in banking. Very few banks, so quite profitable to do banking there. And the other graph is, the top graph is for banks that were in very competitive areas. And what it's saying is the run-up in the distance that you see up there was most pronounced in the areas which were lending in very competitive areas, right? And that's sort of saying the broader point that I was trying to make, that when you have a lot of interbank competition, there's also incentive to take more risk, and that eventually can create some problems for the system. And finally, banks are also susceptible to malfeasance and fraud. One of the interesting papers on this is a paper by Piscorsi, Ceru, etc., where they show that a lot of banks essentially didn't say when they reported some of their securitizations whether in fact there were additional loans that were made. Usually these securitizations had only one loan, and so the remaining was equity that the borrower had. But it turns out a fair number of these also had a second loan which was hidden, and so the amount of equity was actually significantly lower. This was not disclosed before the financial crisis. That's a place where regulation, for example, is important. Fourth reason to regulate: central banks have the ability to expand their balance sheet and substitute for liquid assets for illiquid ones. This is a classic function of central banks. From the dawn of history, this is what they've been doing. They substitute means of payments for more illiquid assets. They did this during the financial crisis also. But there's another sort of benefit from the combination of central banks and government, which is that essentially they have taxation capacity. And so if the system runs out of equity, essentially they can inject more equity into the system based on the capacity to tax areas of household wealth that are inaccessible and can't be raised through finance. So essentially the fact that authorities have powers that commercial banks do not have is a reason for regulation. And finally, and this is the last rationale for regulation, because the authorities intervene, essentially there's another rationale for regulation. And the classic example is the deposit insurance we know about, but the emerging central bank put. The idea is if the market sort of falls considerably, or if the banks get into trouble, the central bank will come in and pick up the pieces. That, in a sense, was a doctrine that became known as the Greenspan doctrine. We will come and pick up the pieces if, in fact, the economy falters. Of course, we can't do much before that. Well, the temptation then, if you know the central bank is going to come to the rescue, is to take on more leverage, to take on more illiquid assets, to become yet bigger, too big to fail. And that's one additional reason why, in fact, if the central bank cannot avoid intervening when the system gets into trouble, it's a reason to keep the system from getting into trouble. Okay, so what forms do microprudential regulation take? The most important sort of form post-crisis has been capital. We've asked for significantly greater capital than the banks used to have. And I think this is absolutely right. We needed the banking system to be much better capitalized. But we have to ask also, how do we really think this capital works? How does it make the banking system safer? There are at least three reasons. The first is equity governance is fantastic. That equity holders, because they have a claim which loses a lot in value if the bank does badly, they have an incentive to monitor the bank and make sure it does well. Unfortunately, this doesn't bear quite well with what happened during the crisis. I mean, think about Lehman. Lehman's board was generally ineffective right till the crisis. In fact, what shut Lehman down was not any action the board took in trying to reduce its risk-taking or etc. It's not even clear to us that they understood how much risk it was taking, but it was essentially an interbank run which shut Lehman down, right? And Lehman got shut, interestingly, by work that Larry Ball does, approximately at the point it became insolvent. It basically, in his estimate, had $3 billion worth of equity when the run on Lehman started. And that's suggesting that debt governance sort of did what it was supposed to do, shut the firm down when it's close to insolvency, but equity governance did very little in keeping the firm from getting there. And so there is a very real question to ask, shouldn't we improve the incentives of equity to take action, and why didn't they take action? So that's one reason. Perhaps if you believe equity governance is better than debt governance, turns out at least the evidence, the casual evidence doesn't seem to suggest that's right. A second reason for capital, relying on capital, is as a budget constraint. You're basically saying, I'm going to monitor how much you allocate in terms of capital to these various activities, and once you've exhausted your equity capital, you can't take more risk, right? That, to some extent, works reasonably well and is the basis that many central banks use for using equity. Here's your budget. If you need to take more risk, you have to expand your budget by raising more capital. And a third reason is through a loss-absorbing buffer that, in fact, when you have a fair amount of equity, that is, small shocks don't take the bank down, it takes largest shocks. So I think the second and third reason are somewhat more plausible. There is a big debate in academia right now. Should we ask banks to hold significantly more capital? And on the side of the people saying significantly more capital, in fact, maybe even all capital, is the Admati and Helwig duo. They've written a book, The Banker's New Clothes, and they argue more capital is the way to go. Now, of course, the papers we talked about earlier would suggest there's a trade-off. If you demand more capital, you may actually increase the bank's cost of capital and reduce the kinds of activities that the bank does. That's a cost, and you have to balance. There is an optimal, which is not 100%, which is not 0%, which is somewhere in between. I think this debate goes on, but we need more empirical work to say what is the optimal level of capital which balances the risks versus the benefits of having less or more capital. We also have moved more towards institutional liquidity regulation. Let me not dwell on this, other than saying that Anil Kashyap and his co-authors raise a relevant question, which is we have two measures, the net stable funding ratio and the liquidity coverage ratio. One is working on the funding side, one is working on the asset side, and they ask the very useful question, well, shouldn't they both be collapsed together? Because what we really care about is essentially what is net short-term debt. That's the source of the problem, and we need to collapse these two. We've also embarked on a bunch of other sort of ways of regulating. We have a number of other sort of ways we have been regulating. Stress tests, an extremely important innovation post-crisis. Many would argue that the US banking system got out of trouble only after the stress tests in March 2009. There is a tremendous amount of value in telling the markets that there are no walking wounded left, that the walking wounded have been taken care of. And the reason for this is if you believe there are walking wounded out there, you're always worried that the prices of certain assets can collapse if those walking wounded essentially have to unload those assets. There is a fire sale discount embedded in the prices of those assets. And because of the possibility that that fire sale could happen in the future, there's always an incentive to keep some powder dry so that you can buy into that fire sale. It essentially acts as a constraint on lending, acts as a constraint on activity if you know there are people who could get into difficulty. So there is value to cleaning up the system, something Japan did in the late 1990s, something the US did in 2009, something that Europe did a lot later, and that may account for the slower progress in Europe in recovery. Claudio Borio argues that these stress tests are much more about building confidence in the system rather than acting as an early warning of what might happen if in fact the system gets into trouble. And that is, I think, consistent with now the growing de-emphasis on these stress tests, saying really the stress tests about saying the system was okay post a downturn, and perhaps less important going forward because we really don't know where the risk may emerge from, and doing these stress tests may give a false sense of confidence that we've protected against the potential risks going forward. There's also been a fair amount of regulation of bank structures. This happens after every crisis. After the 1929-30 crises going into 1933, we had the Glass-Steagall Act breaking up the banks. Now, it turns out there was no real rationale for the Glass-Steagall Act. What the banks were accused of on the investment banking side doesn't actually turn out to hold up in the data. But because the banks were in the midst of the crisis and because people were very, very angry with banks, this became the rationale for regulation. And one could argue that this time around also the Volcker rule, many would argue, was not really dealing with a problem that emerged during the crisis, but it was a way of cutting back on the banks and was in a sense political payback to some extent for some of the activities they did. Of course, some have argued to go further and break up the banks. Let me talk about this central bank provided electronic money or public provision of liquidity, which is something that increasingly people are talking about. And we heard Governor Kuroda also talk about it. Now, of course, the central bank providing electronic money, we have to see what form it takes. But one form that people have argued for is essentially the bank opens deposit accounts for everyone. Essentially, it does deposit banking. And some, like Jeremy Stein, say that the central bank issuing short-term liabilities is actually a good thing because it crowds out banks from doing it and prevents the banks from getting overly fragile as they undertake these activities. Now, the flip side view is that central to the bank's lending function or its production function is the issuance of demand deposits. And if the bank gets crowded out of this demand deposit business by the central bank, then you have to find another way of intermediating to borrowers with the banks being taken out. And whether there is an easy way of doing that, as the central bank absorbs deposits, how is it going to flow that money back into the financial system? That's something that we need to debate. It's not clear how that would happen, and it's something that we need to think about before the central bank crowds out the commercial banks in doing this activity. Let me skip compensation regulation. We've already seen some forms of it, not so much in restricting levels, but in focusing on clawbacks investing. But let me talk a little bit, a few minutes on regulatory incentives and a couple of minutes on macroprudential and finally on whether we should have the same rules everywhere. So the regulatory incentives basically in a boom, nobody wants the regulator to act. It's very hard for you to take actions in the midst of a boom. William Chesney Martin, a famous Fed chairman, said the role of the Fed is to take away the punch bowl when the party gets going. Problem is, nobody's happy at that point, right? And the best you can do sometimes is not add to the punch bowl, not spike the punch bowl even more when the party is going, but taking it away, there's a lot of political resistance to doing that. How do you know that things are going really badly? Things are fine. We don't see any losses. Well, you have to take away the punch bowl when the losses haven't shown up yet, because by the time they show up, it's a little too late. But very hard to do that. So what we have is often pro-cyclical regulation. Because we had a fair amount of regulation, we tend to liberalize. Because the first flush of liberalization goes well, there's pressure for more liberalization, and we liberalize into the boom. Of course, then we have a crisis, and we over-regulate post-crisis, because now nobody objects to regulation, and the market itself doesn't object, because the market at that point is more open to more capital. So we essentially put a whole lot of regulation, but then as we start recovering again, there's an impetus to deregulate once more. Now, in the 30s, we had a lot of regulation. By the 80s, it was seen this was too much, and we started deregulating right into the 2000s and the global financial crisis. Well, post-global financial crisis, we were much more efficient. We regulated very quickly, but we've also become much more efficient in the other direction. We are starting to deregulate at this point, if not explicitly, implicitly. Certainly a lot of pressure in the United States to deregulate at a time when, in fact, you could argue that the system is moving from a reasonable level to excess. And deregulating at this point is like putting more sort of alcohol in the punch bowl right when the party is going. Should we be doing this? Clearly, there is a question that is raised here. Let me skip far. I mean, forbearance is really the idea that can there be some extra incentives to intervene to take away the punch bowl? And those are commitments from outside. I think the new development is an attempt to create endogenous commitment in the banks with these COCO bonds, which essentially require the bank to recapitalize or else have those bonds converting. We still have to see whether they're effective. They're a way of forcing the recapitalization on an institution-by-institution effect. Let me, in the last few minutes, address a couple of questions. One, should monetary policy address financial stability, right? And one argument is no, that monetary policy has really no serious effect on financial stability. And the argument goes something like this, where we raised interest rates, but still the party kept going. How much would it require to stop the party? We will kill the economy with that kind of rise in interest rates, right? Now, the counter argument is that if you focus only on price stability, especially when inflation is really low for a variety of reasons we don't fully understand, financial stability could be jeopardized, and long periods of very low interest rate suggest that liquidity is going to be plentiful for a long time. When liquidity is plentiful for a long time, you get the search for yield, you get the illiquidity chasing, you get the risk building in the financial system, which comes to hit you when finally that long period of accommodation comes off. It may be we're seeing some of that nowadays, the tremendous amount of money that has flown into emerging markets. Now you're seeing as the time of reckoning comes and interest rates start moving up, there are some concerns. Similarly, within industrial countries, there are areas that have benefited from a substantial increase in leverage in the times of accommodation, could have problems as you pull it back. The second reason for saying no is it overcomplicates monetary policy. We already have a big problem communicating. If you think we're also going to deal with financial stability, we have one instrument, which is the interest rate, and having too many targets will complicate things and become problematic. Well, the truth is, if you have one instrument and many targets, it doesn't say that you shouldn't have those many targets. It says now you have to use that one instrument a little more judiciously and trade off these other functions. And I think the debate at this point is, are there any circumstances under which monetary policy should actually intervene to head off substantial financial instability? There are some who argue that it can be incorporated into a medium-term inflation forecast targeting framework by saying if there's a ramp up in financial fragility, it could affect medium-term growth, and therefore heading it off is part of the central bank's function. The third rationale that some monetary economists use is, look, monetary policy is not the right instrument, use macroprudential. The response to this that people offer is, look, macroprudential is untested and it's partial. It works only on the banks. If you constrain the banks, but then the shadow banks do a lot of activity, essentially you may not have achieved anything. And the nice thing about interest rates is it gets into all the cracks, as Jeremy Stein says, and therefore is better at doing this. I think the debate goes on, and I'm happy to answer questions later if you want. Now, that leads to macroprudential regulation, and I think Claudio Borio calls it really well. The objective of macroprudential is to protect the financial cycle from the banks, that is, keep booms relatively contained, and also protect banks from the financial cycle, get them to build up resilience in the times that the boom is taking place. So, for example, one instrument of macroprudential is countercyclical capital requirements. Now, the problem, of course, is in many of these situations, you are acting against the natural instincts of the market. The natural instinct of the market is to demand very low capital in the boom, and in the bust requires substantially more capital. The instinct of the regulator, therefore, is to work against it, but demanding a lot of capital in the boom and demand relatively less capital in the bust. Now, when you have a fight between the regulator and the market, who do you think wins usually? Well, this is where we go back to the point that made earlier. If the regulator has effect on the banks, the market says, okay, hang the banks, let me work on the non-bank system and let them take the risk, and therefore risk migrates. So this is something we have to worry about. We have to deal with shape-shifting finance. If you push against the wishes of the market, you better have the ability to push everywhere. Essentially play what Americans call whack-a-mole. You hit here, hit there, until you kill the problem. But it's difficult, it's not easy. And finally, the last point I want to make is there a need for harmonization across borders? Of course, with all the activity that's happening in Basel, we've sort of gotten accustomed to cross-border harmonization, but with the kind of anti-internationalism that is emerging in country after country, I think as the community of central banks, we also have to ask the question, is this something that we may be going too far on? And the reason for harmonization of regulation is, yes, it creates a level playing field across countries. The smaller countries, for example, in Italy, would say, no, this is skewed towards large country preferences. That, in Europe, there is one or two countries who matter, and it's their preferences which sort of, when they have trouble, they change the rules, but otherwise the rules are binding on us. So that's a concern that these international rules may not be really democratic. Of course, the second reason for harmonization is otherwise you get a race to the bottom. The response is, no, there's no reason why you'd get a race to the bottom. There's no reason why every country would want to pick the lowest rules. If a country has really terrible rules, you stay away from that country. The value of having each country pick a set of rules for itself is you avoid coordinated mistakes. And one example of a coordinated mistake that, with the benefit of hindsight, we could argue was the AAA rating given to subprime mortgage-backed securities. There was a belief these are really safe, so everybody went into them because this gave you the highest bang for the capital buck, the highest return for the amount of capital you were putting. Too many people went into it. That was because every central bank was giving the same dispensation. So could it be that we have sort of more variety and therefore more resilience if we don't have the same rules everywhere. The third reason is a political economy reason, and this applies more to small countries. You go back home and you say, you know, Basel made me do it, therefore I have to do this. You may want to do it, but you can blame Basel. The same way as in Europe, you can blame Brussels. Among central banks, you can blame Basel. Of course, the concern is this reduces democratic oversight, and as a result, it creates problems down the line. Let me conclude. So there is growing recognition that systemic regulation is key. You know, this is an old concern which could reemerge in some places. Competition can impinge on financial stability. I think it's clear that monetary policy is not irrelevant to financial stability. Question is, what do we do about it? Is there a way we can bring it into the equation without completely sort of messing up communication? There is a risk we should be well aware of, which Governor Kuroda also pointed to, that we may be fighting the last battle very strongly, but not fighting the next battle. I think we have regulated banks very well. However, banks have lost talent. The most aggressive traders have left the banks. Where have they gone? They haven't vanished. They've gone into the non-bank financial system. Risk also has migrated there. And essentially, as regulators, we are fighting a shape-shifting target, and we have to be careful that we don't keep regulating specific institutions, but regulate more broadly the incentives in the system. Of course, there are new entities as fintech. We don't want to intervene too early to stop the innovation, but you don't want to wait too late to find out that it's a $300 billion problem and that they have deep deficiencies in them. And finally, we have regulated the banks. There is a very real question we must ask: have we over-regulated them? Again, this is an area for research. I personally don't think we should unwind the regulation till we understand better. And we're in the process of unwinding right now without understanding whether we did the right thing or not, and that's problematic. More broadly, we need broad, robust, and timely regulation rather than micromanagement, just reiterating the fact that we can't deal with every problem in detail. We can deal with the big problems. Let me stop there. Thank you.